Money and metals. Well, I'm going to start with gold this week. Prime Minister of India, Modi, wants to get his hands on Temple gold, estimated at about 3,000 tons, more than two-thirds of the gold held in the U.S. bullion depository at Fort Knox, Kentucky, to help tackle India's chronic trade imbalance. One of the key places this gold is hiding in plain sight is several temples, one being a 2-century-old Shri temple in Mumbai devoted to the Hindu elephant-headed god, Ganesh. Bristles with closed-circuit cameras and is guarded by 65 security officers. One of India's richest temples, having amassed 158 kilograms of gold offerings worth some 67 million and is heavily guarded. India is the world's biggest consumer of gold, and its ancient temples have collected billions of dollars in jewelry, bars, and coins over the centuries, all hidden securely in vaults, some ancient and some modern. Modi's government is planning to launch a scheme in May that would encourage temples to deposit their gold with banks in return for interest payments. The government would melt the gold and loan it to jewelers to meet an insatiable appetite for gold and reduce economically crippling gold imports, which account for 28% of India's trade deficit in the year ending 2013. Sound like a great idea, huh? Take the gold, get interest payments. What's not to like? Modi would also like to convince Indians to open their family vaults, which hold an estimated 17,000 tons of gold and jewelry and other heirlooms. But it would be much harder to convince the Indian families who sometimes have a little faith in financial institutions to break tradition and hand over their gold passed down through generations. India's love affair with gold spans centuries is rooted in the Hindu tradition. The key to Modi's plan, of course, is interest rates. A similar gold monetization plan was launched in 1999 and was very ineffective. The interest rate was 0.75 to 1%. Basically, no one wanted to get such a small interest for their gold. And this plan as well probably is destined for failure unless there's a huge rate increase in the interest offered to the people that are turning over the physical gold. I thought it was one of the most interesting stories in the gold market, certainly for this week. Moving on to the money news, the IMF Lagarde sees a rising currency risk. Sharp movements in global exchange rates tied to a higher U.S. dollar, led by higher U.S. interest rates, are a growing risk to the global economy, according to IMF Managing Director Christine Lagarde, saying last Thursday. Clearly, the exchange rate and the currency risk and the volatility that it creates is one of those rising risks, Lagarde said in a speech at the Washington-based Atlantic Council, adding that emerging market companies were particularly at risk. She also confirmed that the IMF had received its 450 million euro loan repayment from Greece. In other news in the currencies, Central European currencies are expected to mostly retreat in the next 6 months as the U.S. Federal Reserve moves closer to lifting interest rates, a Reuters poll showed last Thursday. Some of the region's central banks are also likely to act to stop or reverse a strengthening of their currencies in order to boost inflation levels from around zero and help economic growth. But once the timing of a U.S. rate hike becomes much clearer, Europe's emerging markets will become relatively less attractive. Standard & Poor's rating service lowered its long-term foreign currency credit rating on Ukraine, surprise, surprise, from CC to CCC-, saying it expected a default on the country's foreign currency debt as a virtual certainty. Continuing in currency news, the Hong Kong Monetary Authority stepped into the currency market again and sold 6.2 Hong Kong dollars on Friday as the local currency hit the strong end of its trading range. It was the second time that the city's de facto central bank intervened in the currency markets since last August. Moving on, the Bank of Mexico sold 52 million pesos last Friday at an average price of 15.16 pesos per dollar. The bank said it was part of an auction program to boost foreign exchange liquidity following a recent slide in the peso. And finishing up in the currency markets and how to play the currency markets, a little twist for this week. Verde Asset Management, Brazil's largest hedge fund with over 30 billion reals, which is roughly 10 billion US under management, posted its highest return in 6 months in March as their bets on a stronger US dollar paid off handsomely. And moving back to metals news for the silver market, is Pan American's dividend at risk? TD Securities analyst Daniel Earl recently dropped his near-term price target for Pan American by $2 to $11.50, noting the dividend is at risk and he expects the miner to have negative free cash flow this year at the recent silver price. Earl rates Pan American a hold, with the major silver mining trading under $10 a share in recent weeks. Under the header, at current prices, dividend may be in jeopardy, Earl argued that while Pan American's balance sheet was strong, with $330 million in cash and equivalents along with no debt, its cash flow situation was poor. At current spot prices, Pan American has negative free cash flow before paying out what now looks like to be a high-yielding dividend, Earl estimated. And that'll wrap it up for this week in Money and Metals.